So what if you could actually be your own bank? But what would be the first steps you would need to go through to be your own bank? And actually, what does it mean to be your own bank? These are the things I want to cover in this video, and I want to break it down for you so that being your own bank is as simple as changing just one thing and adding one step. But before we get into that, let me just throw some things at you. The most important thing when it comes to your money is being in control of your money. But you are not. None of us are, because we have never been taught to be in control of our money. Now let me break that down to you and explain it. We have been taught to get jobs, make money by trading our time for money, right? Every one of us goes to a job, works a business, or does something, and we count hours. Well, I shouldn't say all of us, but 99.9% of the folks out there, that's what they do. And when they trade an hour for a dollar, that results in a paycheck, weekly, bi-weekly, monthly, however you get paid. And what do you do when you get that paycheck? Now I know nobody gets cash anymore, but when you get the paycheck, this is what it technically would look like. You take that money and you put it into a traditional bank. Now, today, in this high interest rate environment, banks pay you interest on your savings, right? And you do whatever it takes to save as much as you can at the bank. I know most people inherently want to save money, but let me talk about what we do wrong and how being your own bank will fix all of that. Here's what we do wrong. We take our hard-earned dollars that we traded our time for, we put it in the bank, and the very first thing we do is we pay our bills. We pay our expenses, we pay our loan payments, we pay our credit cards, our mortgages, our car payments, everything else. And then whatever's left, if there is even anything left, that is our savings. That is also backwards. According to all the laws of wealth, all the rules of gold, everything that has ever been established about money, that is backwards. Because you are the single most important piece of that. You are the golden goose, and without you, none of that exists. But yet, you put yourself last. You pay yourself after everybody else has been paid. Here's what you need to do first and foremost. You need to change who gets paid first. You must keep your share first. And what is your share? Well, that's going to be a sliding scale. But let's just start with the first law of wealth, and that is 10% of what you make. So you take the money that you earn, and then what you should do is take 10% of it and put it somewhere out of reach before everybody else gets paid. Then whatever else is there, you put that in your checking account and you pay everybody else. That would be a tremendous improvement in what you're doing. But that isn't being your own bank. You see, being your own bank would involve changing one thing, which is where that savings goes first, and then adding one step. Now let's go back to that original formula. You worked for money, traded your time for dollars, you put it in the bank, you paid your bills, your loan payments, and everything else. Now just imagine this. Imagine if all the loans that you made payments on, just imagine, okay, that those payments were paid to you, to your bank, to a source, a place, a machine, if you will, that you created. Just imagine that. Do the math. Grab a pen and start writing down all your bills. Car payment, credit card payments, mortgage, HELOC, everything that you pay money to every month, write that down right now. How much does that work out to be? $3,000, $10,000, $15,000? Now, what I want you to do is I want you to then break down how much of that dollar amount that you pay monthly on all your debts, how much of that is interest, okay? Is it half? For your mortgage, it's more than half if you're within the first 7 to 10 years, but just figure out how much of those payments are going to interest. Now I know for a fact, because statistics told me, credit card payments almost all go to interest because most people just make minimum payments. So just imagine all those payments, principal and interest, were paid to you, to your bank. What would your life look like? Well, that is exactly what being your own bank is. All of the payments you make on the loans, not the expenses, not your rent, not your groceries, not your diapers, but your loan payments, your credit cards, your car payments, all of that stuff gets paid to you. You keep all the interest. You are in control. My name's Chris Naugle, and this is what's next if you became your own bank. So after I learned how to be my own bank and how to do what I'm gonna show you how to do, I started using it for everything. The first thing I did is what I just suggested. I paid off debts because I had lots of debts. As a real estate investor, I had credit cards, home equity lines of credit, mortgages, I had all sorts of debts. And every single month I made those payments and I felt broke after paying all those. So what I did is I slowly, and I wanna preface that, slowly started implementing this process, because it is just a process, to take back control of all that money that I gave away. Now, it took a couple years. Make no two ways about it. This is not a get-rich-quick thing. But I started using it to pay off all my debt. And when I recaptured and recycled all the money that I was paying on the debts, what did I do next? I've started buying cars because, hey, listen, all of us have to buy cars, and cars get old, and you have to replace those cars. So when I started buying cars, I started buying them with my own bank. And I made payments back to myself. Now, hold on. What else did I use it for? I didn't just use it to pay off debt. I then started using it to buy real estate, to fund the rehab on real estate. And I will tell you, there was many times that I borrowed from my bank, my privatized banking system is a better way to say it, and I couldn't repay myself until the house sold. And sometimes that house didn't sell for months and months and months. But that's okay, because when the house did sell, I repaid myself principal and all the deferred interest that I charged on the loan. Now that's the hard part for most people, the interest. They're thinking, well, it's my money, I saved the money, why would I pay it back with interest? Well, let me just stop and check your mindset. You are okay making mortgage payments on those rental properties. You're okay making hard money loan payments to the lenders that lent you money on your flip or your real estate deals. You had no problem making principal and interest payments to them. So why would you have a problem paying yourself back the exact same amount you were willing to pay them back at? Doesn't that make sense? Why would it be any different? Why would you be less important? Why would you short yourself, but yet not short them? And who is them? Hard money lenders, private money lenders, banks, institutions, Wall Street, all of them, you make payments to them. I used this to take back control of all that money, and then I also used this, my privatized banking system, to start businesses. I used this to support my businesses when hard times happened, when I couldn't make payroll, when I needed money for a marketing campaign to push in when everybody else was pulling back. I used this for everything. But the most important thing is I am in control of my money now. And I think that is what you need. I don't just think, I know. Because I know how it's changed my life and I know how it will change your life. But here's the thing. A lot of people have no clue what the infinite banking concepts is. Because that's really what we're talking about. The late R. Nelson Nash wrote a book called Becoming Your Own Banker. He did this back in the late 90s. That book holds the secrets of exactly what I'm talking to you about. Now, it has evolved significantly since Nelson Nash's days of teaching the infinite banking concept, but the premise, the process, and what it is has not changed a bit. Because the infinite banking concept, as many people love to think, they think it is a whole life policy, but that is completely wrong. The infinite banking concept is a process. So let me explain that process, and I will make this brutally simple. And then we're gonna talk about why would we use a whole life insurance policy, a specially designed and engineered whole life policy, and why would we use the cash value, take loans from the insurance companies and all that stuff that you've probably heard about. So let's re-roll the tape and go back to what the process is. Great. Let's remember what you started doing. You traded time for money. Here's your money. And what you did is you put this money into a bank. Now let's just envision that money's in a bank. But now what you would do is in that bank you would save money. So let's just picture this is your savings. This was all your money, but this paid all your bills. You saved this. And every single month, every single week, however you save money, that money built up. And then what you did, that you took your savings and you looked over here on the right side. Imagine a circle, okay? We'll put it up on the screen. Here's the circle, okay? On the left side of the circle is your savings, the money that you have saved in the bank. On the right side are the places where you're leaking money. Let's just start with credit cards. So now we've saved up enough money in our bank account, and over here on the right side of the circle, you've got a credit card. And now what we're gonna do is we're gonna take the money from the left side, your bank account, and move it over, and we're gonna pay off the credit card. So now we no longer owe that credit card any money. Now what you're going to then do is you're going to take the same exact monthly payment you used to pay that credit card, and you're gonna send that around the bottom part of the circle, and you're gonna put it back in the bank account. That represents recycling and recapturing money that you used to give away to the credit card company every month, and you didn't even have a problem with it. Maybe you did, but you didn't because you made the payments. Now you make the same exact payment, but you pay it back to yourself. So every month you're recapturing the interest that you gave to the credit card company, probably north of 20%, and you keep doing that. Every month, that interest comes back over to the original source, the bank account. That interest just keeps coming back over, and eventually all the money you used to pay off that credit card is now back in your bank. Okay, you understood that. That's you becoming your own bank because you're taking back control. And if you did that for all your credit cards, all your loans, your car payments, and everything else, you, again, like I mentioned, would have a whole bunch of money in the bank. But now what I want you to do is I want you to envision changing one thing. That is where your savings goes first. So now we take your savings and we put them into this machine, a specially designed and engineered whole life insurance policy. Now, on the left side of this circle, your money's in that specially designed whole life, which I know at this point you're like, that sounds so stupid. Everything I've ever heard about whole life, that is just not a smart thing. Dave Ramsey said that is the dumbest thing you could ever do. Well, let's just see if we can prove Dave Ramsey wrong. As a matter of fact, I know we can. Because now, your money is sitting in this whole life policy, paying you guaranteed contractual interest on your money. How much is that interest rate? Well, with the carriers we work with, it's between 2 and 3.25%. So, is your bank account paying you 2 or 3.25%? Many of you will say yes, but are they paying that guaranteed for the rest of your life and it will never change? The answer is 100% no, because bank accounts fluctuate. The interest rate changes. When the Fed drops the rate, your interest goes down. When the Fed interest rate goes up, you make more money. In the policy, it never changes. So you're making guaranteed interest on all of the money in the policy. Number two, these are mutually owned life insurance companies. So now they pay a dividend every single year and never ever have missed one, not even during the Great Depression for well over 100 years. So now you get interest plus dividends, which is significantly more than what your bank account is paying you. So now we've got a place where that money is earning more than what it was in the bank. But hold on, it gets even better. If it's designed properly, which we will design them properly, that interest in dividends, the growth that you're getting on your money, grows tax-free, which is way better than what you get in a bank account because that money is taxed. You get a 1099 for the bank account interest. In the policy, it's growing tax-free. Now, there's a bunch of other reasons why the whole life is superior to the bank account. I'll just rattle them off. Number one, it's protected against judgments and liens in most states. Bank account, no way. It bypasses probate. Bank account, not happening. Okay, not only that, like I mentioned, it's tax-free. It also provides a death benefit if you should pass away or die too soon. It actually doesn't have to be too soon. It can be any time you die. There's a death benefit paid out to your family. So we're getting a higher interest rate. We're getting a dividend every single year, which is not guaranteed, but it's still, every year they paid them. They're both growing tax-free. We have access and liquidity to use this money, which we're going to talk about in just a second. You have protection against creditors and judgments in most states, and there's a death benefit. I think we found a better place than a bank account. But hold on, let's put that to the test. Remember, now we got the circle. The money now is in that specially designed whole life, the machine. Okay? It is building cash value. What is cash value? Cash value is the amount of money that is building up inside the policy each year. So when you're paid a dividend and paid interest, it is paying to the cash value of your policy. And that cash value is what you have access to use. Now let me be clear, in the first couple years of your policy, depending on how it's designed, you will not have access to 100% of the money that you put in. You will have access to the cash value, which could be anywhere between 60 and 90% of the amount you put in, your premium deposits, but not all of it. So I want to be clear. So let's go back to that original equation that we used, the bank account, okay? We put money into the policy now, not the bank account. And now what we're going to do is we want to pay off a credit card with that money we saved in the policy. So we're going to take a loan from the policy and we're going to use that loan to pay off the credit card. Now, some of you are like, why would I take a loan when I have the money sitting there? That should just be my money. Well, let me explain. By taking a loan, you're not using your money. The loan is the insurance company giving you money from their general account. And on their ledger, what they do is they go in and subtract the amount of the loan, the amount we're going to use to pay off this credit card, from your death benefit. So the loan that you take from the policy is a loan that the insurance company doesn't care if you ever pay back, although we are going to pay it back. But they don't care if you ever pay it back because it's just an advance of your death benefit while you're living. So when you die, the insurance company will make sure that they pay themselves back the outstanding loan and interest, and the remaining amount of the death benefit would be paid to your family. Clear? So why would we take loans outside of the fact that we're not using our own money? Well, we're doing that so that all of the money that was in our cash value continues to earn that guaranteed interest rate plus the dividends they pay us every year, tax-free, without no interruptions at all. So it's uninterrupted compounding growth, even though we took the money out and paid the credit card off. So now we paid the credit card off the same as before, and we're gonna make payments back to our private banking system, the policy, the same way you would have paid back your savings. So the exact amount you were given the credit card, you're gonna pay that money back to the policy. So when you do that, all the money is available to you immediately when your check clears. But not only that, now you're paying the loan down to the insurance company. The insurance company does charge simple interest on the loan. Right now, it's about 5.25%. So they're charging you 5.25, but you're making 5.75, 6%, 6.4, all the carriers are a little different on the money in the cash value. So you can see, over time, you can make a spread, an arbitrage on your money, the same way a bank makes money on your savings. They give you interest on that money and they lend that money at a higher interest rate. You're doing the same thing because when you took the loan out, even though the insurance company charges you interest on that loan you took, you're still earning interest and dividends on all of the money and you got to pay off the credit card. And then when you recycled and recaptured the money you were paying the credit card, you are effectively taking back the interest you were giving the credit card. So you're making money twice on the same dollar. And if you continually keep doing that around and around, you end up making a lot of money, but you took back control of all of your money. You're no longer leaking interest to the banks, the credit cards, or anybody else. You're paying yourself back the interest. The only leakage is the interest you pay to the insurance company, but that's okay because the insurance company continually paid you interest and dividends on all of your cash value. Not some of it, all of it. So let me just pause and ask all of you if you could help me out a little bit. What I'd like you to do is click that subscribe button. I've got over 1,000 videos. I would love to share those videos with you by clicking that subscribe button, but we also do a ton of lives. So right above there's a little bell. What I'd love for you to do is smash that bell. That way you'll be notified every time we put out new content and webinars. All right, let's get back into this process of you becoming your own bank. Now, I just gave it to you in a really simple way. Actually, I went a little long on it, but when you tell somebody this, they're gonna tell you you're crazy. They're gonna tell you, why would you do that? Why would you use a insurance company? Why would you use a policy instead of a bank account? Well, we already went over that, and you can recite some of those things, or you can just start asking them the right questions. And those right questions would be, why wouldn't you use the policy? And they will say, oh, because the policy has big expenses, it pays big commissions, blah, 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 blah. Well, let me hit all those. The policies are specially designed and engineered. Matter of fact, what we do is when we design these policies, we put the lowest death benefit on the policy allowable by the IRS, which what that does is it reduces the cost of insurance because the compensation, the commission, And the fees that the insurance company charges are all based on the death benefit, because that's what you're buying from the insurance company is protection called a death benefit, and there is a cost of that insurance. So by putting the lowest insurance on, that cost is reduced, which means the commission is also reduced, because less premiums that are required for the cost of insurance, the less commission that is paid. So to design these policies, the agent or the person like myself has to reduce their commission by 60 to 90%. But hold on, they're gonna keep going and they're gonna say, yeah, but there's other expenses. Okay, what expenses are there outside of cost of insurance, the commission, which I already told you, we reduce both of those. Well, then there's also a policy service fee. Yes, there is. $50 to $100 per year. And then somebody might say to you something about that loan interest rate that the insurance company charges you. Well, right now, that loan interest rate for most of the companies we work with is about 5.25%. Just challenge yourself or ask them the question back. Where can you go to use money, to borrow money at a rate of 5.25% today? And today is May of 2025. You certainly are not going to a bank borrowing less than 5.25. You're definitely not going to Wall Street borrowing less than 5.25. So unless you are a giant institution borrowing direct from the Fed's balance sheet, you're not able to borrow money at the rate the insurance company is willing to lend it to you. And that is because some of you might be thinking, well, yeah, it's because it's my money. It is your money, and you are borrowing your money, but not really, because you're borrowing the insurance company's money. They're letting you use part of your death benefit. But because of that, remember, you're earning dividends and interest on all of your cash value. I know I already said that, and I'm bringing it back to that. Yes, I'm repeating myself because it is so vital that you understand that. The cash value is no different than the money in your bank account, with the exception of this earns a better return, tax-free, protected against judgments and liens, and it pays a death benefit when you die. So if you care about your family and you want to leave them in a better place, that is a pretty important thing. Now, I could go really deep into the machine, the specially designed whole life, and I could talk about paid up additions, the death benefit, the cash values, all the bells and whistles, but you'd probably fall asleep because that stuff's really boring. But if you want that, down in the comments, tell me what you want me to do a video on and I will do it. I will explain that if I haven't already in the 1,000 videos I did. But here's another way to get info on all of this stuff. There's this thing we created called Money School TV. We like to call it MSTV. And you can go there by going to moneyschool.tv. This is a community that we created. Think of it like TV Guide, but it's all money, all day. We've got pre-recorded videos on there. I've got the most comprehensive infinite banking training ever created. It's over 23 hours of start to finish, most advanced to simplest ways to use the infinite banking concept all in one place. And you get to pick and choose what you want to learn. We do live webinars every week, and we have our mentors who are all policyholders, who are all using the infinite banking concept, and who all have a story of how it changed their life. You see, all of our mentors are required to be using the infinite banking concept before they can tell you how to do it. Now, that sort of just makes sense, doesn't it? How can you show somebody how to do something if you're not doing it yourself? Well, they're all doing it, and they are the ones teaching on MSTV. And here's the best part. You can try MSTV for free for 30 days. And if after 30 days you don't like it, great, we will refund your money. Oh, you're like, wait, you didn't mention that this costs money. Oh, it sure does. It's $19 a month or $190 a year. And if after 30 days you don't like it, you don't want it, or maybe you just decide, I don't know, I just want my money back. We will give you your money back, but you will get to use it for 30 days completely free. So there's no reason not to try it. Go to moneyschool.tv, sign up, and give it a whirl for 30 days. And if you love it, awesome. We'll see you on there. So just to do a quick recap in 30 seconds. Initially, I showed you how you can become your own bank, how to create your own private banking system. I started by showing you how to do it with a bank account. And then we made the point as to why the specially designed and engineered whole life is just a better machine to use for your banking system. Now, once you create your banking system, you gotta change your mindset. You gotta make sure you pay yourself first. You gotta make sure you change where your savings goes first, and you gotta apply that one step, which is that circle. the process called the infinite banking concepts. And hey, listen, I've got a video that I created that literally does a fantastic job of showing you everything we went over in this, but in a different way. If you want to check that video out, it's right here. This is our famous 90-minute video. We call it The Secrets to the Rich. Check it out, watch that video. And with that being said, folks, my name's Chris Naugle. Thank you for being here. Thank you for joining me for this episode of What Now? What's Next When You Become Your Own Bank. We'll see you on the next episode.